This new 14% monthly dividend ETF TSPY could crush JEPI and even JEPQ. Now, in my opinion, I think that TappAlpha's TSPY is going to be way better and could crush other popular monthly ETFs that pay monthly dividends like JEPI, JEPQ, and SPYI, just to name a few. Don't believe me? Well, that's okay, because I had the opportunity to interview the CEO and founder of TappAlpha, or TSPY, Katara. So in this video, you're going to see a full and complete breakdown of TSPY in a whole ETF review with myself as well as me interviewing Katara about TSPY. And yes, we're going to talk about the dividends, the expense ratio, who it's for, zero DTE contracts, literally everything about ETF investing for monthly dividends is all in this video, and the truth about TSPY and if it's actually better than JEPI or JEPQ and other popular monthly covered call ETFs. And fun fact is that Katara actually used at one point covered calls to pay off some expenses for his own life. So if you want to live off of dividends, you're in for a treat in this video, because he's going to talk about how to live off of dividends and so much more is all jam-packed in this video. I legit had 29 questions for Sai. I came super prepared to do my own research and ask Sai every question about TSPY and especially zero DTE contracts and monthly dividend ETFs. It's all jam-packed in this video to see if it's even worth the hype for TSPY, and in my opinion, it could be very much as well. So without further ado, let's get started right now. Welcome, Katara, the CEO and founder of TappAlpha, and we're going to be talking about their newest, or should I say latest, monthly dividend ETF, TSPY, TappAlpha's SPY Growth and Daily Income ETF. Welcome, to the channel.
Marco, it's great to be with you. You know, you're one of the first people that I've actually met in 3D before I've ever done a Zoom call with you. So I think that's really cool. For the folks that are visiting, Marcos and I met at the ETF conference earlier this year, and it was great to get to know Marcos and all the great coverage he's doing. So I really appreciate you having me on and looking forward to digging in.
Totally, it was a pleasure meeting you as well, Sai. Now, this video is going to be a complete breakdown, and I wanted this video to be an investor's ultimate guide on TSPY. Any question that they may have, that they could go back to this video and it can be answered. So if that all sounds good to you, I could go ahead with the first question side. Does that sound good?
Sounds great.
So our first question is, if you can provide our viewers with a brief background on yourself, maybe you can also touch on how you utilize covered call ETFs to pay a portion of your mortgage at one point, and follow up with that, what made you launch TSPY?
I appreciate it. Yeah, it's interesting because I came from a totally different world. I was a computer engineer by trade, ended up going to work in Silicon Valley back in the early 2000s for a startup, and then we ended up getting acquired by Cisco Systems, a big company. So I came from the technology world, actually. And then in 2005, I was lucky enough to start my very own software company. So I built that, ran it for 17 years. You know, we had 60 employees and grew the business to a good spot. But I kind of blinked my eyes and realized half my career was already behind me. And I thought to myself, look, if I'm going to do anything else with my life, like I've got to make a change. And so in October of 2022, I ended up leaving the company that I founded. And I think the other thing that sort of launched me into, you kind of take those timeouts in your life, is my wife and I were expecting our first baby girl 4 months from that date. And that really puts things, I think, into perspective for how do you want to spend your time? What do you want to do? You know, with the resources and the time that you have. So that's kind of what got me thinking, well, I don't know if you all remember, but in October of 22, the markets were way down. And I'd always just been an S&P buy and hold investor just because I was busy with work, and that served me really well over the years. But I didn't want to sell my shares in order to make ends meet. And so my dad, who was an engineer turned advisor, he had always taught me about covered calls. But the magic thing that happened right at that same time was daily covered calls just became available. So those are the zero DTE calls, which literally, like, for those who aren't aware, they're just short-term calls. You can write them in the morning and they expire the same day. And I thought, well, let me try this. This actually has some interesting implications from a risk perspective, but I don't know if it's going to amount to anything. Fast forward 2 months, I was doing this every day, and just the options premium that we were collecting off the SPY shares that we owned covered the lion's share of our family's mortgage. And that was sort of the aha moment. But the challenge was that it took time. You know, if I was working full time, there's no way I could have done this strategy. It took me like maybe 3.5, 4 hours a day. And part of the reason was because I did a lot of math to figure out, hey, where do I want to pick my strikes and what's going on in the market? and then you're constantly recording stuff, and you want to get better, and so you've got to have all the data. It takes time. So with the software background, I ended up writing some cloud-based tools that took 4 hours of work down to under 5 minutes every day. And that was the aha moment. And the thing that really was the motivator for me was just, I was really grateful for the strategy just because it allowed me to be 100% present for my daughter's first year without any financial stress. And so for us, it was such a blessing. And I felt really lucky just because of the experiences that I had. I had parents that taught me about the markets, and I had all these things that I don't think I don't think it's common. And I thought, man, if I can take this stuff and make it easier for other families like ours to experience the same thing, like then we can actually make a positive dent in the world. And so that's how the company was sort of born. And with the software back, I didn't know how to, I was going to get it to market. Was I going to make a software tool? That was my world. So I was like, yeah, I'm going to make a SaaS-based company to do this. But then we ended up meeting some ETF issuers from New York, and they were amazing. And they're like, you know what? You can just take this whole strategy and wrap it inside of a publicly traded ETF and deliver exactly the value you want to with the software, but right to people's brokerage accounts. Nobody has to learn any software. You can manage the complexity of all the stuff that you know, but you can share with everybody else through a publicly traded ETF. And so that's what we did. And we ended up launching TSPY back on August 15th of 2024, which was kind of a special day for us because August 15th was my dad's birthday. And he's the one that taught me all about options and how to use this stuff. So that's the direction we went. We launched TSPY. We've been running it ever since. And part of the reason why I wanted to do this was because when I was looking and doing this for myself, there was nothing on the market that did anything like this. And the goal was essentially, it was simple. I wanted still exposure to the S&P 500. I wanted to own my SPY shares. I just wanted them to do a little bit more for our family. And so by doing this zero dated option strategy, we were able to add daily income. We were able to lower the beta, which means you have a little bit of a difference between correlation with the market. We were able to sort of deliver, back then it wasn't tax efficient income. It was actually very tax inefficient. But when you do it in an ETF, we can talk about that later. It is a huge benefit from a tax efficiency standpoint. And one of the other things was there was nothing out there that was a balanced fund, a balance between I still wanted growth, right? We're still, 40s, so we still have a long time horizon, but we have more expenses that we wanted to get some income yield out of it. But I don't want to take one in exchange for the other. I still need my nest egg to grow, but I still need some additional additive supplemental income. And there was nothing on the market at the time that provided that. And when we launched, I think we're still one of the unique products out there that can deliver those two things. And we do it in a really unique way because we truly own shares of SPY. We're not doing it with synthetics. We're not doing it with swaps. So that's basically like the long-winded story of what got me from technology to now being in the finance world. And so you come in with a fresh lens, and I think that's another unique thing about what we're able to deliver with TSPY is that we really bring that curiosity, that engineering mindset to try and get the best outcomes for our investors. And, additionally, like this is our vehicle too for our family and our friends, and everybody uses it because this is the only product that we found that was able to deliver that stuff. But folks that are also out there in your communities can take benefit if they align with the same needs and the same goals and the same outcomes that we do.
And I think what's amazing about your story is that you are, or at least were and still are, the epitome of an income investor on how, you could use income to pay off expenses. And the goal, I believe, for a lot of income investors is to potentially live off of dividends, right? My next question is, can you go over the investment objective of TSPY and what does it aim to provide investors?
I like to think of it as simply in the simplest terms that I can. So it's kind of like if you already own SPY, ask yourself, do you want more from it? And if the answer is yes, products like TSPY can kind of give you that same core exposure, but it's adding daily income through these zero DTE covered calls that we write. It lowers the beta and it's giving meaningful tax efficient distribution. So we're distributing about 14% annualized. And then the last piece, it is truly a balanced approach. It's growth plus income. Our goal is to try and capture as much of the upside of the S&P 500. And in certain market conditions, because we have this little income engine going, in some market conditions, you can actually even outperform a little bit what the S&P is doing. But then you're really trying to give consistent, smooth, predictable income despite the volatility of the markets. And it's that reliability that we've learned, like in my experience, you need it to plan. And for income investors where you've got crazy volatility like we experienced in April, just having products that can deliver that consistency from an income perspective, I think can really add stability in an otherwise unstable market. So that's really the goal of what TSPY is trying to deliver for investors. And it's really designed for, people that have a little bit of a time horizon ahead of them. They still need growth. They're not fully to the point where they're just living off income, but they still need that supplemental component. And so that's why we sort of landed on a balanced 14% annualized yield.
What makes this ETF special is the fact that I've seen more growth from this ETF compared to other covered call funds that might be giving a, I guess, more capped upside, where the thing about TSPY is the fact that not only can you take in consistent monthly distributions, but the fact that, or at least TSPY has outperformed its competitors like JEPI, like JEPQ, XDTE, and even some other funds that are coming out in the market. Now, I have a chart I'm going to be putting on everybody's screen where in the last month, where we've been kind of in a rebound period from the market, that TSPY is actually outperforming JEPI, JEPQ, which is actually more of a tech-oriented index that the underlying tracks. And then, of course, the main competitors would be XDTE and SPYI, which is also similar type of underlying, which is the S&P 500 by NEOS. Now, even over the last 5 days, outperforming as well, but even on the 1 day, and even days like yesterday when the market was up over 3%, TSPY was able to keep up and be up 3% with the market, and even today as well, while other ETFs that are providing monthly covered calls on the S&P 500 underperforming TSPY. So my question is, how the heck are you doing it? Because this is insane.
I think there's two sides of it. And it both ties to innovation and adopting sort of new capabilities and new mindsets and new tools to sort of deliver the goal. So the first is on the financial innovation side. Zero DTE just came out in 2022, and we were one of the earlier funds to adopt it. So that in and of itself provided some benefits. And then there's the technology and innovation underneath it, the fintech platform that helps us manage the daily positions and does the risk management. So to your point, how did we get 3+% when the market was up about that and collect premium on top? So starting with the financial tool, zero-dated options are really powerful for a few reasons. And I'm a math nerd, and so I won't make a calculus analogy, but one of the reasons is, one of the things when I was trying to figure out how to build TSPY, what options to use. And so the standard is you use a 30-day call and you collect that premium, but then you're on for the ride no matter what the underlying does over that period. Well, what's really interesting is if you took a 30-day call with a static level of risk, call it a 25 delta option, and you sold it and you get X in premium, and then you compared it to a 0-day strategy where you sell a 25 delta call every day over that period and you add it up, guess what the premium potential is you get as a multiple from 0-day to 30-day?
I'm going to guess 4 times.
Nailed it. So it's 4 to 4.5 times X. So the same level, you nailed it. Amazing. No one's ever nailed that before. So the same level of risk, you're getting paid 4X in income, in premium potential by doing 0-day options. And so, there's 2 reasons for that. One, without getting too option wonky, theta decay is like when the option value decreases, it's the steepest closest to expiration. So you're taking advantage of that every day. And the second thing is 0-day options at the beginning of 2025 became the majority of options. They're more than 50% of the options that are traded on the S&P 500. So you get that demand where if you're selling it and there's high demand, you're going to get great prices for it. So those that innovation itself was really helpful to help, be able to set pretty high out of the money like positions, but still get paid reasonable premiums because we're using zero dated options. Second thing, so helpful if you think about like you looked at I think last night, the market was up overnight. We are literally trading, we're true zero DTE. Some call them 0 day, but they're actually 24 hours. We're true zero DTE, meaning we're only short with our option for 6.5 hours a day. And that makes it so much easier to mitigate risk because you're only in play most of the time just for the trading session. So when the market closes, and then overnight, sometimes there's news that'll come out, right? That's when earnings happen. Or before market open, that's when they release kind of macro news like CPI this morning, inflation news. You don't have to worry about mitigating risk with your option position because you're not in play, but you're still on the SPY, and so your SPY is going to catch that. And then when the market opens, most of the time, a lot of times, the news has been digested, and then you can take your position. So that gives us a big benefit in where we actually set our calls in the morning because we don't actually have to battle with what happens overnight. And then the third thing is you get 22 at bats over the trading month versus one. So the analogy I use is if I'm flying from New York to LA and I launch my airplane and I get one chance to point my plane at the runway at LAX, that's great. But then guess what? There's a gust of wind that comes or a low pressure zone or a thunderstorm that throws you off your initial course. There's no way for you to course correct to get back on course. But with zero DTE options, you can actually course correct 22 times over that month in order to have much higher probability that you land at the runway that you intended to. And so that's why I think zero dated options have a really good opportunity to deliver market-like and potentially market-beating growth if you do it this way because of those benefits. On the other side, the innovation side, we have software that helps us take in, there's a lot of signals during the day. So we'll look at historical performance. We'll look at the VIX. We'll look at all the option Greeks, gamma, delta, movements there. We'll look at gamma export. There's a lot of stuff that you can look at that gives you hints. But if I was just doing this manually myself and staring at the screen, my brain can't take it all in and make sense of it easily. So the software helps us take it in, make sense of it, and then it puts a very simple choice in front of me as a portfolio manager. It says, hey, here's the risk, here's the reward. Are you getting, compensated for the level of risk you're willing to take? And we just make sure that that connection is made, and then that selection is done based on the risk profile of the fund, which is kind of low to moderate risk. So we don't, if we can at all help it, we don't take positions very close to the money at all because we have headroom that allows us 80+% of the time to have those option premiums expire worthless. We collect all the premiums, and then that's additive potential income to our investors. So those things put together are really helpful. And then the last piece, I think, on the technology side, we also take into account planned events, and even unplanned events we can manage through. So we're one of the few funds that can dynamically take more than one position in a day. So we can close out a position early. Or if we have to, we can roll it to the next day based on market events that happen. And, the example I use is there's no way I would use the same out of the money position on a day that Jay Powell is speaking at an after Fed press conference as on a day there's no news. And so we have flexibility to do those kinds of things, and that really helps us manage the risk, which I think is showing in sort of the performance numbers that you're seeing with the fund.
So if I could take a couple steps back on TSPY. So TSPY buys SPY, which is State Street's version of the S&P 500. So you're tracking exactly the S&P 500 compared to other funds like, for example, JEPI. It says S&P 500 income, but it's similar to the S&P. It's not exactly one for one, but with TSPY, you're actually holding real shares of the S&P, and then you guys go in every day, 6.5 hours, write zero DTE options on the SPY, and then you guys close it out before the end of the day. So when hypothetically, I think the data is over 60% of the time the market goes up after hours. So when the market goes up, after hours because you guys already got out of that option. You guys are collecting the premium, and the fact that you guys own the real shares, that TSPY is able to capture more upside compared to its competitors and provide both a balanced approach of income as well as growth. Is that correct?
That's exactly right.
Okay, good. I want to make sure I'm getting everything down for investors. So, what type of investor is TSPY for, in maybe a sentence or two?
I'll give you maybe I give a hypothetical story about it if that's okay. So like let's imagine a couple named Mike and Sarah, and they're both in their mid 30s and they're working hard and they're saving diligently. And they're starting to think more, seriously about their financial future. But they're not just thinking about retirement at 65. They're thinking about how to buy back their time sooner. Like that's the persona that I think a fund like TSPY could help. They've been savers. They've maxed out their Roth IRAs. They've started investing in index funds, but they're realizing that building wealth for them, it's not just about purely growth. It's also about generating income streams that they can rely on. And so TSPY in that case is an interesting option for that scenario because they want something different than just like a usual dividend ETF. You don't want to chase high yield stocks because sometimes they might underperform in the long term. And so for TSPY, like what's the benchmark everyone compares to? It's the S&P 500. And 87% of fund managers don't outperform the S&P 500. So we were like, well, why don't we just buy it, the S&P 500? And add an income component to it using an innovative methodology to deliver that income through the options technology that we use. And so the big thing is, it's for that persona where you can give them a way to stay invested, stay in the market, you stay exposed, and you still have participation in the upside of the S&P, but you add that generation of daily income that's paid out on a monthly basis. And that's something that, in my case too, I was able to use it to cover like real expenses, really big, impactful expenses. And, a lot of folks these days are also thinking, hey, how can I get these investments for myself to help me transition out of my 9-to-5 job? And so it's really about, it's not just about like yield chasing. It's about long-term sustainable financial freedom and flexibility. And that's where TSPY, we're hoping people sort of view it as a smarter building block towards achieving that goal.
Now, how I like to think of TSPY for investors is those people who want to not only capture upside with the SPY or with the S&P 500, but also instead of waiting till, 15, 20, 30, 40 years, right, to sell off shares because the dividend yield of the S&P is, around 1.3, 1.4% at any given time. And that's not going to, cut it for some people to, use the income of their investments to pay off expenses or to use however they please. So an ETF like TSPY could also give investors the upside so they could have some solid total returns in the market, but also if they really wanted to, with a monthly income, use that income however they please. Is that correct?
That's exactly right. And the other thing too that I think of this block, and the block is the capital that's invested in the underlying vehicle. And the question is, like, there's some income products out there where that block, it's like an ice block that melts over time. Like you're taking little bits of water off of it, which is symbolic for the cash and the income that you use, but it'll shrink over time. And ideally, like what we want to try and deliver is that ice block that grows over time, where it compounds with the growth of the S&P 500, and it's still providing some meaningful income on top, and that income being distributed in a tax efficient way so that you don't necessarily take the tax impact that you don't have to as short-term gains. And so there's some structural things that we did, I think, that are super unique that other funds haven't done that allow us to take that sort of tax efficient approach as well.
Does TSPY have more upside potential in terms of growth compared to other competitors like SPYI, JEPI, XDTE?
There's a few reasons that the answer is yes, and it depends on who you're looking at. One thing that was really interesting, I'll connect it back to when we were trying to figure out how to implement TSPY, and we did it the hard way, and we fought for it, and I'm glad we did. One of the things that like some of the partners that we were working with were saying is that They're like, why don't you just implement the strategy using synthetics? It's way easier because it's options and options. You don't have to do all the rigmarole to collateralize. And I was like, no, I don't want to. Like, I want to replicate the experience that I had. And to me, it was important to own real shares. And it's like, how am I going to tell my mom, hey, sell your SPY shares and then buy TSPY? And she's like, do you own SPY in TSPY? And I say, no, you own synthetics. You don't actually own the real equity. You own an option that synthesizes it. So we didn't do it. And I'm really glad we didn't, because to your point on growth and like, can we outperform on the growth side? One thing that's really interesting about synthetics is at the end of the year, because synthetics oftentimes are built using SPX, which is an index option. There's a rule that says when New Year's Eve comes, the underlying synthetic that you're using to like replace SPY, whether you realize the gains in it or not, you have to do a thing called mark to market. And because you do mark to market, you kind of like, you have to clock those gains. When you do it in an ETF, ETFs are required by law, by the 1940 Act. You have to distribute 90+% of those gains. Otherwise, you pay taxes on it as the ETF. So if you have a synthetic underlying, have you ever noticed that in December, the distribution for the synthetic ETFs are way bigger than the ones early in the year? It's because of this rule. So they have to do it. So what's really interesting is that means there's no way to store the capital value of the underlying shares if you use a synthetic, because you have to distribute those gains before the end of the year. So that, for me, was a deal breaker, because I want a long-term growth engine that compounds over time. Well, we ended up fighting to own real shares, and so like we never have to, in the cases we don't sell the SPY shares, after New Year's, they just continue on and they grow over time, and there's no issues because there's no mark-to-market rule because we're not using a synthetic. And so the other thing that I realized when I was trying to figure out how do I explain this to like my family as to what would happen after the end of the year, the best a synthetically implemented ETF can do with their underlying NAV is 0%. They cannot actually retain more than 0% in NAV after the end of the year because of these mark-to-market rules. So that's one of the reasons why you see actually like TSPY shares, the NAV can grow over time. And then there's a huge tax benefit to this too, potentially. I'm not an accountant. Go talk to your own tax representatives. But one of the big things is when I was doing this in my personal individual brokerage account, so I was selling covered calls on SPY, I got hit with straddle rules. And basically what straddle rules say is you can buy SPY shares, but when you take a covered call position on it, it's considered a straddle. And what straddle rules say is that the capital gain clock on your SPY shares that you own gets paused. So I can buy SPY and I never sell SPY, but I hold it for 18 months and then I go to sell SPY for a big gain. That's short-term capital gains because of these straddle rules. And I was like, that's not ideal. But when we actually built this into the ETF structure, it's potentially amazing because this is what happens. Those shares that we're writing covered calls on over the period, they're considered short term, but those SPY shares never get sold for a gain. So if you end up selling a share of TSPY 18 months later, we end up handing back to the bank the corresponding SPY shares in kind. There's no tax event, and the only thing that the TSPY investor potentially has to pay is deferred long-term capital gains. So it basically solves the tax problem that I was having in my individual account because of the efficiencies of using ETFs and real shares within them. And so there's, if I was going to do this even on my own, like I would want to do it in an ETF just for the tax benefit. And I did the math just to put a fine point on it. So if you did two scenarios, the short-term gain version versus the potentially tax advantage one, and it identically performed over a 10-year period, after 10 years, you end up with about 47% more after-tax capital in that second scenario where you can do it within the construct of a tax-efficient ETF. It is enormous. And so those are all the things that we were trying to make sure we built into TSPY when we got it out to the market. And so far, it's been performing unbelievable. I'm super pleased that we fought for it because the banks were having a hard time implementing it, and they really wanted us to take the easy route, but we didn't want to do that because we wanted all those benefits in the end.
One of my questions was if NAV erosion would be a concern for investors, and the obvious answer is going to be no, because some people might look at the yield, and the first assumption is, oh my gosh, my NAV is going to be eroded over time. But that's not the case because, well, first of all, we have real shares, not synthetics. And then second of all, grow in NAV and obviously grow in terms of its total return. And so we could cross that one off. And then in terms of the volatility, in terms of the S&P 500 with a lower beta, it's going to be less volatile. Is that correct?
Yeah, less correlated, I would say. It depends on how you define volatility, but yeah, it adds a cushion with respect to here's my bad analogy of the day. Imagine you're riding a rodeo like we did in April. And this gives you a cushion of options premiums to put on your saddle. That's the way I think about it.
Another huge benefit is that tax implications. And from what I'm hearing is that TSPY is as tax efficient or even more tax efficient than even other funds that are in the market. 3 buckets of taxes, if you can, because this is a huge topic in terms of monthly income, because people would, not everybody puts their ETFs in a Roth IRA. I understand age is 59 and a half. That's a long ways away for a lot of people. So if you want to use the income, you have to put it in a taxable account or a regular brokerage account. They don't look at the taxes because some ETFs might distribute mostly unqualified. ROCs, regular dividend ETFs are mostly qualified. So qualified dividends are going to be subject to a lower tax rate. Unqualified dividends will be subject to a higher tax rate than that. And then there's ROCs, this is a whole rabbit hole, but of course I'd always recommend people to talk to your tax advisor with that. But if you could kind of break down buckets of taxes that TSPY has in terms of the premiums and the income and why TSPY is more efficient.
I'll share our actual classifications for 2024. So we launched August 15th. So we did 3 distributions in 24. 17% of the distributions that we distributed was qualified dividend because we take SPY dividends and we just distribute it out to investors. And then the remaining 83% was distributed as return of capital. And we were able to do that hyper efficiently because we found a tax neutral way to get the remaining distributions from the resources that we had in the fund. And so those are the classifications that we did in 2024. The other bucket to be mindful of, and that's another efficiency area, option premium. So when we net, knock on wood, things calm down this year and we continue to generate positive premiums. The premiums that we're collecting are SPX premiums, which is considered a 1256 contract. And those are tax advantaged potentially, talk to your accountant, as 60% long-term, 40% short-term. So that was one of the other things we wanted to make sure. Like when I was trading 0DTE, I was using equity options for SPY, and that was all short-term ordinary income. But when you actually get to use SPX, and one of the reasons is SPX, like one unit of SPX costs $500,000. So not a lot of individual investors can trade it. But that's another thing that I love about ETFs and funds is they provide access to really powerful financial tools for everybody. And this is one of the things that you can now access through a lot of the funds that use SPX, but TSPY as well. You can trade SPX options, which are potentially tax advantage for the option premium. So there's a whole host of reasons when you pool funds, you get multiple resources in, you can get a lot of efficiencies that you can't as an individual investor. And that's one of the things I loved about ETFs. And one of the reasons we wanted to make sure, like the whole goal of TappAlpha is like tap into the, kind of the resources that you have and get more from what you have. But a lot of people don't have access to the time or the expertise or even the infrastructure to do so. But ETFs plus the strategies give people access. And you don't need $500,000 to buy one contract or sell one contract of SPX. You just need $23 to buy a share of your favorite ETF. And that is what I love about the industry.
Now, for investors who are already investing in SPY or who are TSPY and who want to have the best total returns possible, do you have any tips on how to achieve that with TSPY? I'm assuming it's going to be reinvesting dividends, but if you could have a take on that.
Yeah, I mean, T-SPY was really designed to be a buy and hold product. Something that, you hold on to, it stays in your portfolio. It has this benefit of 14% annualized distributions. But if you really want this to work for you over the long term, taking those distributions if you don't need them and putting them back in, because then they're there to work and compound over time on the growth side of it. And here's the other thing about, having a big portion of distributions being return of capital. We're distributing 14%, but like a lot of people in retirement are like, well, I only need 8. Well, the difference between those two, they can take and put back in to T-SPY or wherever they want, and they can do so without a tax hit. What's happening when you do Rock is you lower the basis, but it's just deferring your tax hit over time, but there's no immediate tax implication in doing so. So that's why we decided, hey, let's distribute a little more because income investors want it. And for folks that still want the benefits of being total return focused and growth focused, there's flexibility because you just hit the drip button in your brokerage account and it'll reinvest those distributions. And there's a potentially smaller tax implication for that. So we tried to check all the boxes to take that middle ground to say, hey, we want to give this benefit to the biggest audience we can. There's income investors, there's growth investors, and there's people in between. Maybe if we do it this way, that we can actually make everybody happy. So that's what we ended up doing, and so far so good.
Can TSPY complement a well-diversified portfolio with other monthly dividend ETFs? Because I know people would love to buy other ETFs like your JEPIs, your JEPQs, the Goldman Sachs monthly dividend ETFs, NEOS ETFs. Can TSPY complement a strategy with other living in the same portfolio with other monthly dividend ETFs and or even be the core position in a portfolio for income seekers or even growth investors?
Absolutely. I think it's really diversification is so important across the board. So T-SPY does what it does, and it's focused on the strategy that we've talked about. But other funds do a great job, but they do things certainly a little bit differently. Some are credit spreads, 30-day option strategies. Some are 6 weeks. A lot of the funds that you mentioned are great funds, but having a balance of those things in your portfolio to meet your needs is what's most important. And so distribution timing and the method with which those funds are actually generating their income, a lot of cases are a little bit different. So finding great complementary sets is always a great idea. For us, we sort of took it a little bit differently, I think, than a lot of the competitors from the perspective of, hey, it's the same story. Like when I started doing this, I was a SPY investor. So we designed it kind of to be a SPY complement / SPY replacement. I just want to take my SPY out, put T-SPY in, and oh, guess what? Dollar for dollar, I have the same exposure to SPY, the exact same security. But I'm just adding this new capability on top so I get a little bit more out of what I have. So we really designed it to be a core equity kind of complement or replacement. A lot of the other funds that were mentioned are really like they're super income focused too. So like all these things put together in one portfolio could be a really powerful way to check a lot of the boxes, but diversification is always an important strategy across the board. A lot of those funds are sort of diversified within the S&P 500, but if there's other sort of ways that you want to be non-correlated, like always think about diversification because that's such a powerful tool to make sure you get the security you need to hit the goals that you need to.
The distributions of T-SPY, the distributions were really stable. And that's one thing that I think investors should look at when they look at any sort of ETF that pays a dividend, whether it's quarterly, whether it's weekly, whether it's monthly, that they look at the dividend, either stability or even the dividend growth. But at least for monthly payers, what's super important is the stability of the income. So people could kind of have a good gauge on what's coming in every single month versus some other monthly paying funds where the dividend could be huge one month because of volatility, or it could be super low one month because of less volatility. So do you expect the monthly distribution to be stable? And if so, how does T-SPY achieve that?
We really try. We can't guarantee it, but we really try. And so the way I think about it is this. Think about like four pistons. And those four pistons are the sources of what you can actually use to pay the distributions. And because the cash has to come from somewhere. So first is qualified dividends. Then there's option premium income, which is 60/40. Then there's capital growth potentially that's embedded within the S&P 500. And then there's the core return of capital. And markets are doing this, and those pistons are going to adjust in order to fill out the hopefully very consistent monthly income. So one month it might be higher, qualified dividend because SPY just issued their distribution, and then another month it's higher option premium, and then some months like when the market's down, you got to make up for it with return of capital potentially, right? All those things add up. But here's the interesting thing: from a tax perspective, it's you got to take the whole year into consideration and then look backwards. So you never really know what the future is going to hold this year. You're just trying to basically deliver that consistent income, and you're doing so with those four resources that you have. So our goal is to stay consistent, but we've been able to fill that gap from one of those four buckets in a really, I think, predictable way. We hope to continue that, doing it into the future. And as markets are hopefully coming back and are going up, it gives you access to all those buckets to make sure you can deliver that. And in the long term, like we did in 2024, capital growth alongside of it. So fingers crossed, we'll see what the markets are doing. But last month was a pretty wild ride, that's for sure.
From what I'm hearing, Sai, this fund will not only provide double-digit dividend yield or distribution yield of 14% targeted, you have diversification in this fund because you're actually owning real shares of SPY or the S&P 500. So you have diversification to all the companies in the S&P as well as all these sectors. You also get some solid income because of the zero DTE strategy, and even the upside potential of the S&P, and even the tax efficiency, all in this one fund. Is that correct, Sai?
Yeah, that's the goal, 100%.
I saw that the expense ratio was 0.68%. That is in line with a couple of ETF issuers, like NEOS, for example, has 0.68% for SPYI and then QQQI. Why was the expense ratio decided at 0.68%? TSPY is underlying is SPY. Why not VOO? I'm assuming it was for liquidity, which was back then SPY had more liquidity. Now we see VOO take over and have the highest AUM in terms of the S&P 500 ETFs.
Good questions. So for the expense ratio, 68 bips, some of the other competitors in the space are actually priced 40% higher than we are to do sort of the daily. So some of the ones that you quote are the NEOS funds. NEOS is great. They do a great job. It was so interesting though, because when we priced ours, I didn't know at all what NEOS was pricing. So one of the things that I did, it kind of came from my tech background in pricing strategy. So one of the simple rules of thumb is like, how do you get somebody to change behaviors? Like you can't just provide twice the value of what they pay because it's switching costs is too much. In order to do that, you actually have to provide 10x the value. And when I started sort of doing this trading on my own, my goal was to create an additive 6 to 8% in addition potentially to the S&P 500. And so that's how I started managing the fund. So I said, all right, 6% divided by 10, it's 0.6, 60 basis points. So 68 seems like a reasonable place to give you that 10 to 1 sort of option premium to ETF cost relationship. And then the other thing was part of the reason we don't have to charge 95 bips like some of the others is because we have a lot of activity. Like this is an actively managed fund. And the reason we can do it without an army of portfolio managers is because the innovation and the technology helps us do it way more efficiently. And so when we launch future funds, we'll be able to leverage the same underlying technology. And so that's one of the reasons we're able to price it so efficiently compared to some of the competitors that are more in the 95 bip, 99 bip range. Some of the other funds that are priced at 68, they're also doing monthly or 6 weeks. And so it's just less. When you're doing it every day, there's so much that has to be done. And we felt that this was kind of the right price point to deliver all the value that we want to, but doing it in a really efficient way using the innovation and technology that we have.
I'm going to cut you off there. So it sounds like with TSPY, you're getting more value for your money in terms of what TSPY does compared to other funds that are maybe priced at 68 bips.
We think so. It depends on how you define value, and
Right.
I'll let you say the comment, and I'll leave it at that.
Will TSPY ever switch the underlying to VOL because of the liquidity? I know it's probably a question people might have.
Yeah, it's a good question. So the difference in cost is 9 bips versus I think 2, so it's a 7 bip
0.03.
difference annually. So the short answer is potentially. One of the things that, like, as an engineer, we always, perfection is the enemy of good. And so we wanted to get this out to the market and get it going. And to exactly your point, SPY was the most liquid. So we wanted to make sure from a liquidity standpoint, we had it from both securities and most importantly, the options, because we're trading those every day. You could actually collateralize SPX options with VOO as well. So short answer is maybe over time, that'll be an optimization. For now, like the 7 bips difference, like if we can get the strategy right, like hopefully 7 bips will be like something that we can make up for everybody in a day. But that's besides the point. To your point, yes, we can always look to improve, and potentially VOO could be another move, especially now that it is the most liquid security on the planet.
Are there any other funds on the horizon for TappAlpha? I know a popular index is the NASDAQ 100. However, I'm assuming, unlike other funds that will hold a similar version of the NASDAQ 100, I'm assuming that's going to be on the horizon where TappAlpha will actually hold the Qs, QQQ for liquidity. Are there any other funds on the horizon for TappAlpha?
Yeah, so TDAC would be the same strategy that we're using on TSPY, but applied to the Qs. And what's great is the underlying technology has all of the inputs. They'll just have different data in them to get a similar strategy execution on the Qs. So very excited for TDAC, and we plan to launch that as soon as TSPY hits 50 million in AUM. TDAC will be next on deck. Beyond that, there's been a lot of discussion. Like, we originally secured the ticker for TRUS, which would be the Russell, but there hasn't been tons of interest in the Russell. And so the other components, we're thinking about different compositions to run the same strategy on, but essentially switching out the underlying securities. So it can either be an index. I like the index style because you get that diversification, but there's a ton of momentum also for single stock discussions too. Haven't decided if we're going that direction. And then one of our sub-advisors is really experienced in sort of leverage and figuring out the right fit for our investor group if we're able to give access to the right kinds of leverage. So those are some of the things on deck that we've talked about. TappAlpha as a company is really for low to moderate risk investors. And so when we start to get out to more exotic stuff, that's not a fit, I think, for what we're trying to build here. But long term, I think if we take the same core strategy, the sky is the limit for other opportunities to build really compelling ETFs. I think we just want to continue proving the model for TSPY, and then we can stamp out lots and lots of value for investors.
If you had maybe one piece of advice for any dividend investor who wants monthly income, or maybe somebody who wants to live off of dividends, what advice would that be?
I think the biggest kind of perspective to share is just really look under the hood for what you're looking to invest in. One of the things that I saw when I first kind of joined this industry was there's this false equivalency that people equated high distributions with high total returns. Those two things are not the same. And so when you see a high distribution rate, that does not mean that security is necessarily going to grow over time. And so those are the things that it's really easy to get distracted from seeing a stat and then misinterpreting it. So just really dig in, understand like the apples to apples metrics to look at when deciding where to invest your dollars, and really think about what do you need, because there's always a trade-off. So if I take a super high distribution ETF right now and I use it, but I don't need all of that income right now, guess what I'm taking it away from? Future growth, capital growth, future compounding, that benefit of time. Versus if I'm just doing, growth investing, but I'm running short on income that I need. So finding that balance and understanding how to actually look at it apples to apples is the most important thing. before investing any dollars. And then the other piece is just, think about the apples to apples impact of not just the investment, but like it's not what you earn, it's what you keep. And so taxes are a really big component, especially when you're thinking about income investing. So if there is a big short-term tax hit, in order to get access to those resources now, you've got to make a plan for whatever your time horizon is to make sure those things all fit. But those are the two things that I saw when I came into the industry. I was like, wait a minute, people are misinterpreting this statistic for yield as the wrong thing. It's not total returns. It's a very different thing. And so just be wary when you're looking to invest, because it's so important to make sure that you're able to meet the goals that you need to.
Thank you so much, Katara, the CEO and founder of TappAlpha, for talking about TSPY, TappAlpha SPY Growth and Daily Income ETF. Now, if you guys like this video, please give it a like, because this Q puppy did. And if you guys want to see me rank other monthly income ETFs, you guys could see it right here. Love you guys so much. Crushing the stock market, and take it easy. Peace.